All right. Welcome, everybody, to this month's housing market update, March 2025. We're going to take a look back over February's numbers as well as January as well. I have a lot of very interesting information set up for you here. Also, maybe an indication of a bubble. And I'm going to show you what I'm talking about in just a minute. So stay with me here, and I'm going to jump right in. I took some information from the Wall Street Journal, and I asked Copilot to give me a breakdown of it, and that's what you guys are seeing here. So there's some really good talking points. Number one, in terms of new home sales, new construction, sales dropped 10.5% in January compared to the previous month of December. And on a year-over-year basis, meaning January of 24 versus January of 25, it was also down 1.1% in terms of new home sales. So that's interesting because what you have is a situation where you have some outlets reporting that there are just simply not enough homes to meet the demand and the number of people, the population in the United States of America. Builders aren't really building them fast enough, and I think builder confidence is not necessarily where they want it to be as well. So that's going to be interesting to see what happens over the course of time with new home sales. Existing home sales also dropped from December to January, but that's somewhat typical in almost every year, down 4.9%. However, January sales were up 2% year over year, marking the fourth consecutive month of annual increases. That's hopeful news right there. So that means January, December, November, and October, 4 months in a row, were all up in terms of the number of sales from the previous year. So that's good news. Continuing the recap here, 2024 was the lowest level of homes sold since 1995 for the second straight year. So this is a tough environment for those who are trying to make a living from the real estate transaction cycle. Attorneys, mortgage lenders, title companies, real estate agents, so on and so forth. We all make money when we do transactions, and we don't until we transact. So it's been difficult for everybody in those industries. However, it's like the perfect seller's market because you see here that rising prices, median existing home price in January of 2025 was $396,000 nationally, which is almost a 5% year-over-year increase. So prices are continuing to rise, and you're going to see, we're going to get into regional numbers in just a little bit. You'll see that as well. Available homes inventory rose compared to last year, but remains below normal levels. So it's better, but still not where we need it to be. But the good news is it's not declining necessarily, right, on a national basis. We're going to talk about that in a little bit. And then, limited supply continues to drive higher home prices through the roof, basically. This was also interesting. A tale of, two realities, right? Areas with rising inventory. Texas, properties for sale are up 20% above pre-pandemic levels. That's good for them. Florida, housing stock expanded 15% since 2020. Colorado inventory exceeds 2019 levels. So of course we sit here in the Northeast, and it's noted that New Jersey is one of them that we just have inventory below half of pre-pandemic norms. So it's still extremely tight in our area. So as I talk to others in the network and ask them how their markets are doing, they're flying, they're doing great. And I'm like, oh, good for you. We just have no inventory here in the Northeast to sell. And a lot of that comes down to, in some of these other areas of the country, it's much easier to get the right to build, to be able to, build more units. They just have more inventory to deal with than we do here. It's just difficult to get these planning boards to come around and give the approvals. So right here again, builders had 118,000 unsold single family homes. It's the highest since 2009. That's interesting, right? And I think that's the reason why a lot of builders are pulling back in certain areas. The new construction is concentrated in South Florida and Texas. That's why those numbers are up. Just like I said, strict zoning. Illinois, Jersey, New York, all those, they have strict zoning. It's hard to get things built. It's just not easy to create inventory in these markets. Mortgage dynamics. We're going to talk about this in just a little bit. Higher rates on outstanding mortgages, 21% versus 18% in the Northeast. More mortgage-free homeowners equals greater seller flexibility. So that's down in the South. It just seems like there's more people free of a mortgage in the South, and they're able to unload their properties because they're not so concerned about a variance between what they have an existing rate and what they could get. This is also interesting too. Look at the valuation in the past 5 years. In Florida, price increased 64%, Illinois 42%, New York 17%. So home ownership costs in Florida metros are 44% of incomes in 2023 versus 28% in 2019. It just means that there's a real affordability problem in Florida, and probably Texas as well. And that's why you're seeing maybe some more inventory come back, because people can't quite afford it. All right, the next thing I want to talk about is an article that one of our own, Jackie Krasuski, brought to my attention over the weekend. And as soon as I saw the headline, I dug deeper and I dug into the article, and it was quite astonishing. And I think that this is, news to a lot of us. We're going to hear from my big sis, Amy Green from Quintessential Mortgage Group later. She was saying that basically a lot of this was known, but what wasn't known is the fact that the government is essentially paying off people's mortgages for them that are falling in default. There's a program out there now that's creating this bubble. So let's just go through these talking points so you can understand a little bit more about it. So federal policies allowed borrowers to take on larger mortgages that they can afford. This goes back to the Obama era, where they were trying to, get the economy going, get more people in homes, understood. So they allowed people to exceed the 43% of income qualification for government-backed loans. So it allowed people to borrow more money than historically they were able to in order to get into the homes. 7% of FHA mortgages issued last year went seriously delinquent within 12 months. That's higher than the 2008 subprime crisis peak of 7.02%. That's alarming. That's alarming. Now, the reason why we haven't heard about this, and excuse me, this was an opinion article on the Journal, and it was backed by information from the FHA's website. So this is not really an opinion. I pulled out the facts and put them on these slide decks. The Biden administration pays off missed payments for borrowers and service. That took place, in the last administration. And basically, they didn't want to create a groundswell of foreclosures. So that's why they did it. Now, would it have been the worst thing to have some foreclosures coming on the market? In my opinion, no, absolutely not. It would have been a good thing. It would have released some inventory. So here's another fact. Only 9 foreclosures out of 52,000 delinquent loans came to fruition last year. And this has been going on now for some time. So basically what's happening, excuse me, my throat is not working the best today for me. Debt accumulation. So missed payments are basically being tacked on to the loan principal without interest. That's essentially what's happening. People are delinquent. The government has a program where they can just kick it to the back end of their mortgage, and they're basically kicking the can down the road. So the FHA has made 556,000 payments to servicers last year to prevent foreclosures. So this is big news. There's no doubt about that. So what are the broader consequences of this? Well, servicers are profiting from the relief programs, which could incentivize risky lending, right? If a servicer can make money by just finding people who are falling behind their mortgages, and they can just tack it onto the back end and it's easy, it's human nature. Like, they're going to seek out people and they're going to do this. They're just going to speed up the problem is basically what happens. And then, relief costs, because at the end of the day, somebody's got to pay for all this that's going on, is, passed on to taxpayers and home buyers through higher mortgage rates, right? And then what's ultimately going to happen is that many FHA borrowers owe more than their homes are worth, limiting their ability to sell. I mean, right now, maybe a lot of them are not underwater, but it could be potentially a big problem in the future if they can't get out from under the amount that they owe. So I just wanted to bring it to everybody's attention that this is going on. And here's the last, chart on the slide deck here, is that This is the share of borrowers with debt to income ratios higher than 43% from 2000 to 2024. You can see this trend, this upward trend, where we are now approaching 70% of FHA borrowers with debt to income ratios higher than 43%. So it's a problem. This is a real problem that should not be ignored, and hopefully it's dealt with, and hopefully they do. It's a hard thing for those experiencing the delinquency, right? And it's easy for me to say, oh, well, they shouldn't be doing this, right? Because I'm not the one in that hardship situation. So that's a really tough spot for people. But, history repeats itself. And I can tell you that I did live through the last downturn where we had to grind through a ton of short sales and help people avoid foreclosure and bankruptcy so that they could maintain a reasonable credit worthiness so they could get back on their feet. I did live through that. And I can tell you there's nothing great about it. It's kicking the can down the road and not dealing with the issue up front is just a false sense of security. It needs to be dealt with. So I'm hoping that our government can somehow get this right and straighten it out, and maybe wean people off this program and get these units through the process of getting people back on their feet. Because right now the market is so high that a lot of these people could probably turn around and sell their home for a profit and actually make some money and get out from under this debt load that they have. Yeah, it's going to mean that they need to, downsize their obligations and ultimately live within their means. But that's the best thing for people. It's important that we live within our means. So hopefully they'll turn that around. Now, before we head off and talk about mortgages with Amy real quick, I want to just bring you into some market stats for Orange and Sussex County, New York, a little more locally. I worked with my son, Marco, who's a high schooler, to clean up our charts and give us some better data. Bravo, Marco, you did a nice job here. So what we did was we aggregated the two counties so we can get a look at everything on both sides of the border, New York and New Jersey. And unfortunately, what we're seeing is that the number of new listings is still down. Basically, 1, 2, 3, 4, 5, 6, 7 years in a row, the number of new listings in February has continued to go down. Now, it's not by a very large margin, so that's the good news. It almost looks like we've maybe flattened out, but time will tell. So that's the story on new listings. I've always said this, and to me, this is the most important metric: units sold. There's really nothing more important than knowing, are things selling or not? And you can see, once again, we are down a tick in January, or down a tick in February. So again, it's been a very slow start to the year. I'm hopeful that the better weather that we're now experiencing is going to make a big difference in the marketplace, because real estate really truly is a fair weather business. But needless to say, you can see we're not out of the woods yet. We're not seeing any real upward movement in the number of transactions. So we got to hold on tight, all of us that are, involved in the transaction cycle. But look at price, continues to go up. It's really remarkable, right? When you take a look at where we were in 2019, average price of $250, we are now over $450,000. That is almost 100% increase in 6 years. That is a remarkable inflationary factor. So, you start to think about, all right, well, when you start putting everything together, well, if this FHA thing really is a bubble and it's going to release a lot of, foreclosures into the market, and we start to see more inventory, could that impact price? I mean, at some point, price has got to cool off. But right now, there's no end in sight to the price increasing that is happening. Oops, sorry, I hit the wrong button there. Average sale price. So days on market climbed a little bit. That's a good sign. It means that things are sitting on the market a little bit longer. That's hopeful news. And also the asked to sold ratio came down a tick in February too. It was up at a pretty high, the highest rate in 6 years for January, almost 101%. So basically what this means is that homes are selling on average for more than asking, 1 percentage point higher than the asking price. So that's all I have for you this month. I think there's a lot of really great talking points in there for your clients. And I hope that you guys found that to be of value. And I want to just check in real quick before we wrap it up here with my big sis, Amy Green from Quintessential Mortgage Group. Amy, welcome.
So, good morning, everyone. It's a pleasure to be here with you today. And again, Jeff, awesome presentation. A lot of great information there. Just to touch briefly on mortgages and rates, just a quick update. Since February 12th, which was our last sales meeting that we were all at, rates have slightly improved. Also, the CPI inflation report was released this morning and came in lower than expected. So that's good news. Um, so right now, the 30-year fixed is floating in the mid to high sixes. On February 12th, the national average on that was about 7.13, down to about 6.79 today.
Mm.
So it's good news moving in the right direction. Jumbo floating in the high sixes, 30-year FHA floating in the low sixes, 30-year VA also floating in the low sixes. And all of this that I'm talking about is with no points, right? Because obviously, if you want to pay points and buy your rate down, you can do that as well. The 15-year fix is also floating in the low sixes. Also, on Friday, the 7th, Fed Reserve Chair Jerome Powell emphasized again that officials are not in a rush to lower interest rates. So that's where we're at right now. Just a quick recap on that.
Yeah, that's great. Thanks for that. And just to recap real quick. So, 10-second update. Last month was a little bit higher than where we are this month, correct? That's
Yeah.
the takeaway. So we're trending in a better direction, which is great. And so you're telling me the 30-year fixed is mid to high sixes right now?
Yes.
Great. Yeah, so my one thing I would say is that I feel like if that 30-year fixed can level out around 6%, I think we're in a good place. I think that's somewhere where we can live and we can have a more normal marketplace come back to us. But that's just me. What do I really know?
Supposedly the magic number is like 5.82.
Okay, so I'm close.
Yeah.
All right, sounds good. Thank you, Amy. I appreciate it. And thanks everybody for joining us
Yeah,
this month.
thank